Hello everybody, this is John Gilbert at Security First Asset Management with a weekly market update for the week ending April 28th. Now before we hop right into that, I'd like to thank everybody who attended our food truck and shred event this past Thursday. We had a real good turnout. Our next event coming up is going to be our car show. That will be May 16th. Now as far as that goes, we invite everybody to attend. If you or someone you know might be interested in entering your vehicle, please give us a call for more information about that. That will be in the back parking lot at the Macon office. If you have any other questions about any events coming up, please visit our website, www.sfamga.com, for more details. Now let's transition into market news. Last week, the S&P 500 and the other major equity benchmarks, they snapped a string of 3 consecutive weekly losses. So the NASDAQ composite posted a gain of more than 4%. The S&P rose almost 3%, while the Dow Jones Industrial Average rose less than 1%. So the gains were in response to a very busy week of earnings reporting. Stocks rebounded as tech earnings spawned a market rally. So on Friday, the Magnificent Seven, as they were nicknamed last year, powered a broad U.S. stock market rally. The prior week, though, big tech had been hit very hard, and so that was a bit of a rebound for big tech. Now, this past week, the Commerce Department also reported its GDP for the first quarter, so it expanded at a 1.6% seasonally and inflation-adjusted annual rate. Now that's well below the consensus estimates of 2.5% that they were kind of expecting. This is the slowest pace of growth in nearly 2 years. The sharp slowdown in government spending and a widening trade deficit are partly to blame for this. Also, we've noticed a trend here lately where consumers are continuing to rein in their spending, particularly on goods. So over the past year, we have seen that a much lower personal savings rate among consumers. The Commerce Department also reported last week that its core, minus food and energy, personal consumption expenditures, which is the Fed's preferred inflation gauge, that it rose at an annualized rate of 3.7% in the first quarter. Now that's well above the Fed's target goal of 2%. So we're having a little bit of stickier than expected inflation. That combined with the slowing economic growth has a lot of investors and traders kind of rethinking the Fed rate cuts later this year. If you remember, in March, the Fed said that they were going to be lowering interest rates, that they were tentatively going to be lowering interest rate 3 times this year. With the negative inflation data and some of the slowing economic growth signals, it's looking like that is not as likely. Some economists are even predicting that there will not be a rate cut this year. Now, as far as that goes, we're just going to have to wait and see. We're going to have to keep on looking at the data and to see what decisions they are making. So something to look out for the upcoming week, the Fed is actually having a meeting this week where they might give us some hints as to what they're kind of thinking. The April jobs report will also be coming out, and Apple and Amazon are going to be reporting their earnings. So be on the lookout for those things this next week. That is all for the weekly market updates today. Thank you so much for watching.